Bitcoin and crypto have come a long way in the last few years. What started as a grassroots movement for financial freedom is now being taken seriously by some of the biggest institutions in the world. We're seeing Bitcoin ETFs go live, hedge funds allocating billions, major companies adding crypto to their balance sheets, and even governments exploring Bitcoin reserves. Some people think this is a good thing. It brings legitimacy, regulatory clarity, and more money into this space. Others believe it's a trap, that institutional involvement goes against crypto's original values and turns it into just another Wall Street asset. So what's actually happening? How do we know if institutions are truly adopting crypto? And what does this mean for the future of Bitcoin? Today we're breaking it all down. We'll look at how institutional adoption is evolving, what's real and what's just hype, and how you should think about this as a crypto investor. Let's start with the biggest question. How can we tell if institutions are actually buying Bitcoin? Unlike traditional finance, crypto is transparent. Every Bitcoin transaction is recorded on the blockchain, meaning we don't have to rely on press releases or speculation. We can actually verify movements on chain. And anyone can do this at any time. One of the best tools for tracking institutional movements is Glassnode. It provides detailed data on large Bitcoin transactions, exchange inflows and outflows, and long-term holder accumulation. Another key source is public filings from major companies and hedge funds. For example, publicly traded companies must disclose their Bitcoin holdings in quarterly reports. Websites like bitcointreasuries.net track these numbers in real time. Right now, we're seeing a clear trend. Institutions are accumulating Bitcoin, but they're doing it in different ways. Some, like MicroStrategy and Tesla, are buying Bitcoin directly and holding it on their balance sheets. Others, like hedge funds and pension funds, are investing through Bitcoin ETFs, futures, and other derivatives. This brings up a critical distinction: real adoption versus financialization. There's a big difference between holding actual Bitcoin and buying a Bitcoin ETF. Bitcoin ETFs make it easier for institutions to gain exposure to Bitcoin without actually holding it. But there's a catch. Investing in a Bitcoin ETF does absolutely nothing to support the Bitcoin network itself. When an institution buys spot Bitcoin and holds it in cold storage, that Bitcoin is removed from circulation, reducing supply and increasing scarcity. But when an institution buys a Bitcoin ETF, they're not actually buying Bitcoin. They're buying a paper derivative that's managed by an ETF provider, companies like BlackRock, Fidelity, or Grayscale, for example. This benefits the ETF provider, not the Bitcoin network. ETF holders don't contribute to Bitcoin's decentralization, security, or even network activity. And here's something even more concerning. Institutions now have the ability to short Bitcoin using these ETFs, meaning they can profit off of price declines just as easily as price increases. This is exactly what happened with gold. After gold ETFs were introduced in 2004, they initially helped increase the price, but over time, they gave Wall Street an easy way to manipulate the market. Gold became just another traded commodity rather than a decentralized store of value outside the system. The same thing could happen to Bitcoin if we're not careful. So does this mean institutional adoption is bad? Not necessarily. It depends on how institutions are using Bitcoin. Let's look at some of the biggest players entering the space. MicroStrategy now holds over 190,000 Bitcoin, making it the largest corporate holder. Michael Saylor has been one of Bitcoin's strongest advocates, arguing that Bitcoin is the ultimate store of value and that corporations should use it as a hedge against inflation. I don't completely agree with all of Michael Saylor's intents, but anyway, Tesla also holds Bitcoin, though it hasn't added more since its initial purchase in 2021. However, Elon Musk's companies are still experimenting with Bitcoin and Dogecoin payments, particularly for Tesla merchandise. On the asset management side, BlackRock and Fidelity are leading the charge in bringing Bitcoin ETFs to the mainstream. BlackRock's ETF alone has brought in over $15 billion in inflows since its launch. We're also seeing governments start to adopt Bitcoin. El Salvador made Bitcoin legal tender in 2021, and while it faced criticism at the time, the country has continued to buy Bitcoin, integrate Bitcoin payments, and even launch Bitcoin-backed bonds. Other countries like Argentina and Nigeria are seeing Bitcoin adoption grow organically as inflation devalues their national currencies. So where does this leave retail investors? The reality is institutions are here to stay, whether you see it as a good thing or a bad thing. Bitcoin is no longer just a niche asset for tech enthusiasts and libertarians. It's being integrated into traditional finance. For retail investors, this means a few things. First, Bitcoin is likely to be more stable over time. Institutional involvement means higher liquidity, which reduces extreme volatility, but it also means slower price movements. Bitcoin may not see the explosive parabolic runs it had in the past because large players are trading it more like a traditional asset. Second, Bitcoin is becoming harder to manipulate by retail traders. In the early days, Bitcoin pumps were often driven by coordinated buying from whales or retail hype cycles. Now, with institutions involved, price action is more structured and manipulation moves to a different level. Big players can now short Bitcoin, hedge their positions, and control price swings differently. Third, self-custody is more important than ever. If institutions are pushing Bitcoin derivatives instead of actual Bitcoin, retail investors need to hold real Bitcoin, not paper Bitcoin. If you're holding Bitcoin through an ETF, a centralized exchange, or a custodian, you don't actually own it. The best way to make sure you're benefiting from Bitcoin's long-term success is to hold it in cold storage with your own keys. To recap, institutional adoption is a double-edged sword. On one hand, it brings legitimacy, liquidity, and regulatory clarity. On the other, it introduces financialization, price suppression, and centralization risks. Bitcoin ETFs do not contribute to the network. They benefit Wall Street, not Bitcoin users. The real adoption happens when companies, governments, and individuals hold real Bitcoin, use it for payments, and integrate it into real economic activity. I want to hear from you. Do you think institutional adoption is good for Bitcoin, or is it a way for Wall Street to take control? Let me know in the comments. And if you want to learn how to navigate crypto with confidence, check out learningcrypto.com. It's the best place to get real, practical crypto education without all the noise. Thanks for watching, and I'll see you in the next video.